All right, let's talk crypto. Everyone, and I mean everyone, is obsessed with the price charts, right? Is it going up? Is it going down? It's a total roller coaster. But what if I told you that staring at the price is like showing up for the last 5 minutes of a movie? You miss the whole plot. Today, we're going to rewind the tape and look at the actual architecture of how these markets really move.
You know, it's the first question anybody asks. You see these absolutely wild price swings, and you can't help but wonder, is this whole thing just a giant global casino? Are people just betting on random numbers going up and down? It's a totally fair question, but it might just be the wrong one to ask.
And this right here is the core idea for our entire explainer. The people who navigate this market, the ones who do it well, they're not just throwing darts at a board. They're reading the tea leaves. They're interpreting a constant flow of information. They are looking for signals.
The best way to think about it is like this. The price you see flickering on your screen, that's just a tiny, visible tip of a massive iceberg. All the real forces, the weight, the momentum, the direction it's really heading, all of that is happening under the water, completely out of sight for most people. So let's go explore what's happening beneath the surface.
So where does it all begin? I mean, before a single dollar moves, before any trade gets made, it all starts with something way, way simpler: human attention. This is the first layer of our architecture. You can think of it as the digital marketing layer, the engine of crowd psychology. What are people typing into Google? What coins are blowing up on social media? What are the news outlets and the big influencers talking about? This is literally how demand starts to form. And this is the crucial point here. Tracking stuff like search data and social analytics, well, it isn't just for marketers. In the crypto world, it's an early warning system. It shows you exactly where the collective curiosity of the market is pointing, which, more often than not, is a preview of where the capital is about to flow. And look, this isn't just some abstract theory. You can actually see it in the data. What you're looking at here is Google search interest for Bitcoin and Ethereum over time. You see those huge, sharp peaks? They almost always line up with big news events or major price rallies. It's a surge in public curiosity. And the valleys? Well, that's when people lose interest. By tracking this pulse, you can see where the crowd's attention is starting to focus, often well before the big price moves happen.
Okay, so attention is where it starts. But let's be real, clicks and searches don't move markets. Money does. So let's move to the second layer and see how this all builds up. We're talking about capital. This isn't about what people are curious about, it's about what they actually do. So when we talk about capital, we're really looking at the system's plumbing, the actual verifiable flow of money. We're tracking things like on-chain movements, which are public transactions on the blockchain. We can see if money is flowing into exchanges to be sold or off of exchanges into private wallets to be held for the long term. We can even track the total supply of stablecoins. Those are the digital dollars people use for trading. It's kind of like financial forensics for the crypto world.
And this just nails the difference, doesn't it? The price of some small coin can be pushed around by just a handful of trades. It can be noisy and super misleading. But verifiable on-chain flows of billions of dollars, that's a whole lot harder to fake. That tells you a much, much truer story.
And the scale of this capital layer, it's just staggering. I mean, take this number from DeFi Llama. Over $123 billion with a B are currently locked in decentralized finance protocols. Now, that doesn't mean it's stuck. It means it's being actively used for lending, borrowing, and trading inside the crypto ecosystem. It's a measure of how much capital is actually participating.
Then you've got this. Over $300 billion exist as stablecoins. Again, think of these as digital US dollars. This is so important because it represents the dry powder of the market. It's cash sitting on the sidelines, ready to be deployed into assets like Bitcoin or Ethereum. So when this number goes up, it suggests the market's buying power is growing.
And believe me, that capital is not just sitting there. Over $9 billion was traded on decentralized exchanges in just one 24-hour period. That is an incredible amount of velocity. It just shows you how active this capital layer is day in and day out.
So we have attention and we have capital. But there's one more layer we have to understand before we can even talk about price, and that's risk. This is the fragility layer. It's all about figuring out where the system is stressed and where it just might break.
Now, from a regulator's perspective, risk gets painted with a really broad brush. Here you've got SEC Chair Gary Gensler calling Bitcoin a speculative, volatile asset. And you know, he's not wrong. But for traders inside the market, that's just the starting point. It's kind of like saying the ocean is wet. Yeah, it's true, but it doesn't really help you navigate the specific currents and riptides, does it?
See, inside the market, professionals look at risk in a much more detailed, granular way. They're not just saying, oh, it's volatile. They're asking specific questions. How much leverage is built up in the system? Where are the big liquidation levels that could cause a crash? Which protocols are depending on each other to survive? And is the story, the narrative that's driving the price about to fall apart?
And that is the key. Big crashes, they rarely come out of nowhere. They happen when one of these specific risk factors gets stretched too far and finally snaps. Understanding where those stress points are is like having a map of the market's fault lines.
Okay, so we've got our 3 hidden layers of the iceberg: attention, capital, and risk. Now, let's put it all together and see how this whole system creates the price movements that everyone is so focused on.
This is the sequence. This is the order of operations for how markets actually move. First, attention shifts as a new idea or a new story captures everyone's imagination. Second, real capital starts to flow toward that story. Third, as the price goes up, risk builds up in the system through things like leverage. And only then, at the very end of this whole chain reaction, do we get that big price move that makes the headlines.
So here's the thing. Most people are completely fixated on step 4. They are purely reactive. The real edge, the professional's advantage, comes from analyzing steps 1, 2, and 3. It comes from understanding the system that produces the price, not just staring at the price itself.
Which brings us right back to our very first question. A casino is a game of random chance. But a system that generates observable signals, attention, capital, risk, that isn't random. It's incredibly complex for sure, but it can be analyzed. It's a signal processing system.
So the takeaway here isn't about which coin to buy tomorrow. It's about giving you a new way to see the market. Instead of just staring at the price chart, you can now look deeper at the whole architecture underneath it. So I'll just leave you with this question. Now that you can see the system, what signals will you start to watch?